All right, let's talk about something that's on a lot of our minds. Have you ever really stopped to think about whether your family would be okay financially if, something happened to you? It's a heavy question, I know, but it's such a crucial one. So today, we're going to demystify life insurance and get right down to it. How do you actually figure out how much coverage you really need? Let's jump in.
So, here's our game plan. We'll start with the absolute basics, just to make sure we're all on the same page. Then we'll kind of dissect a policy and look at all its moving parts. After that, we're going to tackle the big one, the how much question, by digging into two really important ways to calculate it: the human life value method and then the needs based approach.
Okay, so first things first, let's really get back to basics. What's the whole point of life insurance anyway? Well, at its core, it's really just about creating a financial safety net for the people you love. When you boil it down, a policy usually gives you one of two main types of benefits. First, there's the death cover. This is the one everybody knows, right? It's the payout your family receives if you pass away while the policy is active. But then there's also something called a survival benefit, which is kind of the opposite. It's a payout you get if you actually outlive the policy term.
All right, let's move on and look at the anatomy of a policy. All that jargon you see in the contract, it's super important to understand what it all means so you know exactly what you're getting into. First up is the sum assured. This is the headline number, the big one. It's the total amount of money your policy is actually for, the lump sum that gets paid out when a claim is made. Then you've got the premium. The easiest way to think about this is like your subscription fee. It's what you pay, maybe monthly, quarterly, or once a year, just to keep your insurance policy active. And trust me, this is key because if you stop paying, well, that's where the trouble can start.
And then there's the term. This one's super simple. It's just how long the policy lasts. It's the period of time your coverage is actually in effect, whether that's for 10 years, 20 years, or maybe even 30.
Now, for some policies, especially the ones that have a bit of an investment component, you might also hear about bonuses. A guaranteed bonus is something that's often paid out for the first handful of years. After that, you might see a reversionary bonus get added on, and that one is usually tied to how well the insurance company's investments are performing.
So this brings us to a really important question, one that I'm sure is on a lot of people's minds. What actually happens if you stop paying your premiums? I mean, life happens, right? Things come up. So what are the real consequences? Well, it's a pretty clear path, but you really want to avoid it. It all starts when you miss a payment. Now, the insurance company doesn't just cut you off immediately. They give you what's called a grace period, usually about 15 to 30 days to get that payment in. But if that window closes and you still haven't paid, that's it. The policy lapses. And here's the kicker. Once it lapses, it's inactive. No benefits can be claimed. It's a big deal. But hold on. If your policy has been running for a few years, it's not always a total loss. You usually have a couple of options. One is to surrender the policy. Basically, you end it right there and get some of the money you paid in back as a cash value. The other option is to convert it to what's called a paid-up policy. This is pretty interesting. It keeps the policy active, but that main coverage amount, the sum assured, gets reduced. Let's use an example to make this crystal clear. Say Surinder has a policy for 10 lakhs, and he's supposed to make 50 premium payments. But after 10 payments, he stops. So he's paid for 10 out of the 50 premiums, right? That's 1/5 of the total. So his policy becomes paid up, and his new sum assured is now 1/5 of the original, which comes out to 2 lakh rupees. Makes sense, right? Okay, so we've got the basics down. We know the lingo. We know how a policy works. Now it's time for the main event, the question we're all here for. How in the world do you figure out how much insurance you actually need? What's the right number for that sum assured? So one of the main ways to tackle this is a method called the human life value, or HLV for short. The whole idea behind HLV is pretty simple, actually. It's all about replacing the future income you won't be there to earn for your family. So what does that mean exactly? Well, think of it this way. Your HLV is the lump sum of money today that represents all the future paychecks your family is counting on. It's a way of trying to put a single value on your total financial contribution over your entire working life. All right, let's do a quick check-in to make sure this is all landing. A little true or false question for you. Imagine your expected salary increase, let's say it's 8% a year, is exactly the same as the return you could get from investing money, also 8%. In that scenario, would your human life value go down? What do you think, true or false? And the answer is false. And this is cool because it gives us a really handy shortcut. Whenever those two numbers, your income growth and the investment return, are the same, the math gets super easy. Your HLV is just your current yearly income multiplied by how many years you have left until retirement. That's it. A really great rule of thumb to keep in your back pocket. Okay, so the HLV method is great. It's a solid starting point that's all about your income. But there's another way to look at this, one that gets a lot more personal and detailed. It's called the needs-based approach. And just like the name says, this method looks at what your family specifically needs to live on. The best way to get this is to walk through an example. So let's talk about Anil. Step 1 is figuring out how much income his family truly needs to replace. So we start with his total income, and then we take out the stuff that's just for him. His personal spending, his loan payments, his insurance premiums. After we do that, we're left with the amount his family needs to live on each year, which comes out to 9,96,000 rupees. Okay, so that's the yearly number. Step 2 is figuring out the total pot of money, the corpus they'd need to generate that income stream. And not just for 1 year, but for the next 31 years. Once you factor in things like inflation and potential investment returns, the number they'd need is about 2.36 crores. But wait, we're not done yet. What about debts? You definitely don't want to leave your family with a big loan hanging over their heads. So for step 3, we add any big liabilities. Anil has an outstanding loan of 40 lakhs. We add that to the pot, and now the total they need jumps up to 2.76 crores. All right, we're on the home stretch. The last step, step 4, is to subtract what he already has in place. We're not starting from zero, right? Anil's got an existing insurance policy for 1 crore, plus another 50 lakhs in investments. So we subtract those assets from the total amount they need. And after all that math, here it is, the final number, the gap. The additional insurance cover Anil needs to make sure his family is totally protected is just over 1.26 crores. And that is the number he should be shopping for. See how that gives you a really specific target? So there you have it. We've gone through the what, the why, and the how. We've walked through 2 really solid methods for calculating your insurance needs. So the only question left is the most important one of all. Now that you know how to do it, what's your number?